Okay, so thanks for coming back for week 2 of our series. I'm going to start off where we left off. So last week we talked about budgeting, proactive budgeting, and I'm just going to share a couple of resources and then I'm going to flip to a couple new presentations. So we're just going to go through some resources really quick when it comes to budgeting. So once you have your paper budget done, you can, and it's all settled. And remember, it takes about 3 months to get this right. But once you do that, there's a lot of resources out there to make budgeting a lot easier and from the palm of your hand in your phone. Um, there's a lot of apps out there to choose from that you could use over your phone and on the computer for budgeting. I am a huge fan of Every Dollar. Mint is very similar. But Every Dollar, what it is your paper budget. You can transfer it onto the app. So every line that you spend money on that we've talked about in our budget, you can add that line and then write how much you're budgeting. So let's say you're going to save or you're going to plan on about $60 for electricity, $30 for water, $100 for your phone bill. All of these get a separate line. And then when you spend the money, you can go in there and click it and write how much it actually was. Let's say you plan on your electricity being $60 and you get the bill and it's $54.95. You go in there and you say that it was $54.95 and it will tell you how much you have left. You have $5.05 left of your budget. It's really nice because for your grocery budget, that may be a larger amount, or eating out budget may be a larger amount, but every time you spend, you just drop the amount in there and it'll tell you how much you have left. So for those of you who are trying to stay within a budget, a certain amount of money every month on certain things, it's really nice because it does the calculations for you as long as you just go in there and write it in. At the top of most of these apps will tell you what your income is. So you're going to put in how much your income in. If that changes, that's okay. Just fix it. But every month it carries this over, which is really nice because you're not retyping everything in. So for me, I have in my lines paycheck 1, paycheck 2, because I get paid twice a month, and some stuff for my son, things like that. And I can plan on my paycheck being the same amount every month because I'm on salary, but let's just say um, something changed, or maybe I get a raise or a bonus. I can go in there and just click my paycheck for that month and type in how much I actually did make. So then it tells me how much I make on how much I have on the top and how much I've actually spent for the month. So I kind of know where I'm at. Anyway, I would highly suggest once you figure out your budget, pen to paper, go find an app that works for you. It's really nice. Like for my phone, I just open it up and I have it right here on my app. And sometimes at night, because I'm this person, I know not everybody is, but I'll go in there and do my budget for next month. Maybe, let's say registration is due, or I know there's a bonus coming, or something changes in the calendar. I can change up my budget. So, and I can also go in there and kind of predict the future financially, which is nice. So I would say find an app that works. They repeat everything, and oftentimes they're free. They should be free. Like Every Dollar and Mint both have a paying component where you could pay $10 a month and it will actually connect to your checking account and do all of this for you. So it'll know how much you spent at the gas station, how much you spent groceries, things like that. You may have to change a few things, but not very much. I have never known a person who needed to pay for the app. Though it seems convenient, there's no need for it. You don't need to spend money on something that will become second nature to you once you give it a month or two, especially if you know your budget. So definitely find something that works for you. You may have to try a couple. I know several people who don't like the colors of some of the apps or don't like the graphics, and that's the reason they don't choose them. I am one of those people. I really like Every Dollar's color scheme, and I like how aesthetically it looks. I like how easy it looks to me. So that's the one that I use. So find one that works for you. Find one that you're going to use. Otherwise, it's kind of pointless. So that is my comments on the resources when it comes to budgeting. So now I am going to just switch over my screen here to another PowerPoint I have. And we're going to kind of, we're going to add on to the budgeting conversation here. So this is needs versus wants. Just gonna make sure here, got somebody else coming in. So perfect timing for that person to come in. Okay, so now that we have our another guest with us, welcome. We will get started on needs versus wants. I just want to make sure if somebody could let me know if the whole screen is the needs versus wants. That's what you see.
Yep.
Perfect. Okay. I only ask because I have done this so many times where I think everyone can see the screen and no one can. So I always try to make sure. Thank you for the thumbs up. Okay, so needs versus want. What is this? So we have, let's say in theory, we have our budget. We've written down what I talked about last week or the last time, your reality-based budget. What do you spend your money on? That is the first thing we need to talk about when it comes to budget building. It's just the reality of what we're spending every month. Now, we're going to go back and we're going to make changes to that, especially if you can't afford that lifestyle, but we need to know what we're spending our money on before we make any changes. Now, needs versus wants comes in because we can look at that reality-based budget and say what needs to be on here versus what I want on here. And I'm going to go through what that means when it comes to deciphering what a need versus want is. And we have one more person join us. Okay, so here we go. So let's talk about what needs to be in a budget and what we want in a budget, okay? So the first and foremost is what is a need? Okay, this is a universal conversation here. What is a need? Food, shelter, transportation, and utilities. When we think about survival, these are the things that we absolutely need for survival. We're not talking about debt. We're not talking about credit. We're not talking about anything like that. In order to survive, we need food on the table. This doesn't mean eating out, but it means food on the table. So we're talking grocery store. We need shelter. Shelter can take on a lot of types. It can mean a house, an apartment, living with someone, a shelter itself, whatever that might mean to you, but we need somewhere to sleep at night where we feel safe. So shelter. Transportation, again, one of those that takes on many forms. Transportation could mean your own car. It could mean Ubering every day, ride sharing, a bike. I worked with a gentleman who that was his transportation was a bike, and he was budgeting for a new bike. That was how he wanted to get around town. It could mean parking fees if you say work downtown and you need to park, because we have to park in order to get to our job to pay our bills. So transportation, it also could be a bus pass. Transportation is one of those vague ideas, but we need to get from point A to point B, however that is. And there should never be a reason why we don't have transportation, because in Lincoln, we have the public transportation. We do have an option for that. And also, just side note, as I've found out in the last several years, if you or your children have Medicaid, there's actually a number on the back of your card that Medicaid will actually set up transportation for free to get people to doctor's appointments or therapeutic appointments. So if you're looking for that, like they will actually like pick kids up from school and take them to the doctor. They won't go in, but it's a ride share situation and it's all for free. So fun fact there. And utilities, that is the last thing on our needs list. We have to keep the lights on. We got to keep the water running. We got to keep our AC and heater on because we live in Nebraska and we have those extreme colds, but we need utilities. So food, shelter, transportation, utilities. So if you're looking at your reality-based budget, the budget you have made that says, this is just the reality of what my lifestyle looks like. What I would love to see you do is write next to it an N, each category, if it's a need, and then we'll get to a want. So if it falls into one of these categories, it's a need. Now, a want is everything else. So we have concerts, new pets. Obviously, pets are in, we got to still feed them. So that falls under food, to provide shelter. But new pets, that's a want. Eating out, I said food is a need, but not eating out because that's more expensive. We still have to have food on the table. So it could be grocery money. Movies, sporting events, new clothes. Now, I do understand that clothes are an essential, but in the city of Lincoln, and I would say a lot of our big cities in Nebraska, there are so many options to get free clothes that I like to tell a lot of folks that you do not have to budget for clothing in the state of Nebraska. There's someone there. So I'm talking new clothes if you're one of those that likes to go out shopping, things like that. That is not a need, that is a want. If you have a job that we talked about this, that you need certain clothing for, I understand. We've got to buy that, but that might be a one-time thing or an occasional thing. But I'm talking new clothes, frivolous spending. That's all a want. So everything else outside of food, shelter, transportation, utilities is a want. Okay, these are just some categories here. And when it comes to budgeting, needs always take priority over wants. Always, always. Somebody said retail therapy though. It's like a therapeutic thing, right? It's still a want. It is absolutely still a want. Okay. So when it comes to a tight budget, your needs always come before your wants. So in your budget, when you wrote N next to your needs, write a W next to your wants. And I like to have people do this because when we're trying to narrow down our budget, maybe we're spending too much, maybe we're spending more than we make, and we've got to make some cutbacks, we can go straight to our wants. And we can ask ourselves a few questions, which I'm going to get to, when we're trying to maybe lighten the load on our budget. So like I said, it's important to list your needs first and then your second wants. Okay. Your wants second. We have to understand which one is which. Okay. We can decrease our spending on a lot of those items. A lot of times with our needs, we can't decrease the spending. Now, food is one of those that we can, because eating out, if we eliminate that from our budget, which is not always a reality, but if we eliminated it and spent money on groceries, we are decreasing our food budget. But we oftentimes struggle to minimize our grocery budget simply because we have to have it. Now, we could probably decrease it a little bit by shopping sales, things like that. But in the grand scheme of things, I think limiting the food budget usually is the eating out budget. Okay, so I have this in a little worksheet. I'll send it, and so that you can kind of get some ideas. There on the wants list, I add a new thing, cable. That's a want. You do not need a cable to survive. Now, I have a 4-year-old, and I probably couldn't survive without Netflix or Disney Plus, but that's my trade-off for not having cable. I haven't had cable for years and years and years because it was so expensive, but I pay for a couple streaming services and then trade with some family members so that we kind of have all of them. So, but I know if money were tight, that would be one of the first things to go is streaming services, clubs, sports, vacations, gifts. I'm a big budgeter for gifts so that I can be proactive about it, meaning I'm saving all year for Christmas. But if money is tight, that goes out the window. That does not become a priority. And then a new phone. We need phones, and it's on the needs list, but we don't always need new phones. Okay. A lot of us who have iPhones are paying these things off for 2 years. I get that. But to keep going on that, and like once you paid off, get a new one, we don't need to do that if money is tight. Switch back over to the needs. There's a couple more on here. Phone, insurance. We've got that goes with the transportation is insurance, gas. Absolutely. We've got to pay on our debt, minimum payments. That's something that we need to do. And then car maintenance, saving proactively for car maintenance, if it's in your budget, is a very wise thing to do, simply because if you need new tires tomorrow and didn't plan on it, that could be $500-$600 that you don't have. So planning proactively for that. So just because it's outside of those 4 categories, the food, shelter, transportation, and utilities, if you look on this needs list, it does fall into those categories, even though it may not seem like it, but it really does. But this is like essential stuff that you cannot live without. So deciphering that is really, really hard sometimes. But if you've got some wants on your list that you are trying to make a need, ask yourself a couple questions. Do I have the money in my budget for this? So if you've got the money for every one of your wants, some of your wants, of course, put it in there. Absolutely. Can I buy it cheaper somewhere else? Especially a want. If you're saving for, say, a new TV, can you shop around for it and then maybe save some money on it? If I wait, will it become less expensive? Maybe, a new phone will, the one you want, if you wait a little bit longer, it won't be the newest phone. It will be one step under, something like that. But if I wait, will it become less expensive? I always tell people at the end of summer, when I do these kind of presentations, we're starting school back up, August, September. I like to tell people don't buy any electronics during that time because they're going to go on sale after Thanksgiving. So during the fall, certain things just never go on sale for stores until after Thanksgiving. So buying electronics during the fall, please wait until the holidays to do it. So it's one of those, if I can hold off on a new TV, it will be significantly less money. And then most importantly, with your wants, can I live without it? Just because it's on your list doesn't mean you can't take it off the list. It also means you could just decrease how much you're putting into that. So I said this last time that I have a coffee budget. It's kind of my allowance. It's in there as allowance, but it mainly goes to coffee. Let's just be honest about that. But when I'm tight on money, I will eliminate that. I can live without it, or I'll just decrease that amount that I'm spending. And honestly, when money is tight, I hang on to my cash really well because I see it and I'm a visual person. Like I want to hold on to my money. So my allowance is one of those where I'm like, I don't want to hand it to the barista. I get like shaky about it. So it's one of those that I just hold on to it because money's tight and I don't want to spend it all because I may need it next week, something like that. So those are some questions to ask yourself when it comes to the wants on your list. So in closing on this one, go back to the budget that you've already created, our reality-based budget. Evaluate which one is a need or a want, and then actually go back to your needs and say, are some of these a need? I mean, you might have to second guess yourself. Is this actually a need or is it a want? Ask yourself if you can eliminate anything from your wants list. And if you can't eliminate it, can it be decreased? Can we not put as much money into eating out or our coffee or our shopping? And yes, we can afford to, but do we have to put that much money into the want? And then can we make it more practical and less expensive? I'm not much of a shopper, but I know a lot of women are, especially therapeutically. I mean, I love Target, don't get me wrong. So actually this last week, my best friend said that she rarely goes to Target anymore. We kind of both have this addiction to Target. She rarely goes in. She does it all on the app and we were talking back and forth, if we don't see it, we won't buy it. So if we don't go down the aisles with the pretty things, then we won't buy it. And I actually I had to go grocery shopping this past weekend and I did all on the app. I was just like, you know what, let's save some money this weekend and just do it by the app. And I did the drive up where they delivered it right into my trunk. And so that was a way to make it more practical and less expensive. I still got what I came for, but I didn't get any extras along the way. And it was so hard, but it felt really good to know that I wasn't being tempted by all the pretty things in Target that I love and adore that probably shouldn't be buying at the end of the day. So those are some things to ask yourself as you're building your budget. We don't have to take our wants out completely, but maybe we just decrease them. Okay. So now I'm going to head over to another PowerPoint here. Does anybody have any questions about the budgeting, needs versus wants? Any questions from last week that we could go over? And feel free to reach out to me during the week if it's kind of a private conversation. I'm happy to talk to you about those things. And my contact will be at the end, or Veronica has it too. Feel free to use the chat box too if you want. And you are able to send direct messages to me on chat so that not everybody has to see it, but I'll still ask the question and not call you out on it if you want to go that route too. So, okay, well, budgeting conversation is kind of coming to a close. I refer back to it a lot. So if you didn't get the last time, the budgeting lesson from last time, we do have a YouTube version of it. So feel free, Veronica has that. She said that she sent it out, but you can ask her again for it. So reference back to that and build your budget. And if you have questions, feel free to reach out to me. That's what I do. I work one-on-one with people. So if you're just having a hard time building that budget, or you have questions about needs versus wants, I'm happy to help walk you through that. And we do have someone who missed last week. So if you could send that to them. And every week I'm going to put these on YouTube and we'll get them sent out. They're always going to be about a week late, but we'll do it as fast as we can. Okay, so let's go into more financial literacy, just really basic concepts. So today we're going to be talking about one of the topics is checking versus credit. What is the difference between debit versus credit? Okay, so we're going to quickly talk through this one. So what is credit? And our next lesson is actually going to be establishing credit and building credit. So this is kind of our foundation here. What is credit? Okay, we hear your credit score. I need more credit. I need to build my credit. What does this mean? So credit is your ability to borrow money, goods, and services with the understanding that you're going to pay it back. Okay, that's really what it means. So think loan. Think in terms of loan. So your credit score really is just a number that evaluates your ability to pay something back. And it's assessed by how much money you're borrowing, how good you are about making your payments on time every time, if you skip payments, if you've defaulted on anything. So all of these things make up a credit score, and everybody's credit score is on the same scale. Everyone's evaluated the same way, but everyone will have a credit score. Everyone will, and it's attached to your social security number. Okay, so if you have a social security number, you have a credit score, especially if you're over the age of 18. So credit is just really your ability. That's the key word, your ability to borrow money and pay it back. I've heard it said once that it's a determination of how reliable you are as a human being. It's really just a score to say Caitlin's reliable or she's not reliable. That's what a credit score is. So what is a credit card? So a credit card is the loan. It's essentially a loan. When the card is used, a balance accrues, which the payee is responsible to pay every month. So I'll put my name in here. When Caitlin's card is used, a balance accrues to which Caitlin is responsible to pay it back every month. So I'm taking out a loan on a monthly basis. Now I don't have to pay back the whole loan, but I have to pay back part of the loan and at least a minimum payment. Good credit is built upon paying that loan back in full on time. That's the best way to earn great credit. If you pay even the minimum payment on time, it will still help your credit, or paying a little bit over the minimum payment, that will help build your credit. What will not help build your credit and that credit score is not paying. That is the worst way. You will not build credit. It will be decreased. But a credit card is essentially someone loaning you money that you're swiping a card for, and then it's your responsibility to pay it back. So what is a checking account? A lot of people call it a debit account. A checking account is a deposit account at the bank that allows for withdrawals and deposits of cash. So it is an account that you put money into, you put cash into, and now you are able to take that cash out or swipe your debit card in order to use it. Okay, it's kind of an in and out bucket. I could put money in it, I could take money out of it, but it's accessible to you. So a checking account, and I'm guessing they called it checking because we wrote checks for it and that was good as cash, but almost no one writes checks anymore. So I'm wondering if maybe that checking account phrase will go away and it will be called something else. But I always think of it as a debit account. I can debit something. I can charge something on my debit card and it's going to come out of my account that day as if I went and got cash out. Okay, so that's what a debit is. So think cash. So the difference is your credit card is a loan, your debit account is cash. Okay, a debit card is attached directly to a checking account. You have to have the cash in there. Your debit card will withdraw money directly from your checking account in real time to pay for goods and services. So think cash. It's just a card that's going to take cash out and give it to Target when you pay, and it will do that immediately. Whereas my credit card, I'm going to get a bill at the end of the month. So think cash when you think debit, think loan when you think credit. Okay, so a lot of folks will ask, how do I build my credit? How do I start my credit? A lot of the adults that I work with now on a one-on-one basis, after the first meeting that I have with you, I will instruct you to pull your credit. We want to see what's on there. What's in your name? Do you know all the cards, all the accounts that have been opened in your name? Any loans, collections, medical bills, anything like that will show up on your credit report. Your credit score is maintained by one of these three companies. They all do the same thing. You can go to any three of them or annualcreditreport.com. That's where I always direct folks. But I tend to go to Equifax or Experian for some reason. Usually Experian is mine that I go to. But you can pull your credit report, which is everything that has ever been done on your social security card financially. Your social security number, excuse me, financially. So I started a credit card when I was 18. So if I pulled my credit report, and I'm 36 now, I'm going to see 18 years of everything financial. Every payment I have made, every account that I've opened and closed, everything is on my credit score and my credit report. And I ask folks to pull this once a year. It's free to do this once a year. You'll get a full report. It's really good to do this once a year because if your social security number was stolen, and somebody opens something in your name, you can fight it. And the great thing is you're not responsible to pay for that. You just have to contact one of these companies and they will do it for you. So if you see fraud on your account, say there's a loan that you didn't take out, you can call Experian, TransUnion, or Equifax, and they will fight it for you. There's a lot of things that can be done with your credit report, but you have to pull it. You have to know what's on there. So if you're getting your budget together, kind of trying to fix some debt that you may have, please pull your credit report. It will actually give you your actual credit score, where a lot of people use Credit Karma, the app. I use it. I look at it often, but it's not going to give you your real number. It will be close, but it won't be your actual number. So you need to pull your credit report. So if you haven't done that this year, it's only March, you haven't done it in the last 12 months, I would suggest doing it, maybe just for kicks and giggles to see what's on there. But a lot of times people have things in collections that they didn't know about, and simply because they've moved. So a lot of times medical bills will end up in collections because you went to the doctor, then you moved and you haven't updated your address. So things just get lost and it ends up in collections, which means your credit score is going down, down, down. So it's always good to check that out and get those things taken care of, which we will talk about in upcoming weeks about collections and bad accounts and things like that. So this is one way to increase your credit score, is just checking out what's there and then taking care of what's there. So this is kind of our foundation for the next thing of building credit and how to do so. So I'm going to open that up here. Establishing, increasing your credit. We'll do screen share. All right. So on to the next one. Does anybody have any questions right now before we start establishing and increasing your credit? Okay, here we go. If you are over the age of 18, I said this, you will likely have some sort of credit score. For a lot of folks, they've never had a credit card, they've never taken out a loan, so they may not have anything on there, but there's a good chance that everyone I'm talking to today has some sort of credit score. If you are under the age of 18, you likely do not. It doesn't mean it's not possible, but it's likely that you don't, unless some things have happened, which would include fraud. So I'm going to speak in terms of talking to folks that have a credit score, and maybe we're not establishing it, but we're still going to talk through establishing good credit and increasing our credit. So feel free to ask questions along the way. All right, so we're back to kind of what we were talking about. What is credit? Your credit is your ability to borrow money, goods and services with the understanding you're going to pay it back. So again, it's really your reliability. It's your level of reliability. Can Caitlin pay this back? Will she? And based on her history of taking out loans or credit cards, does she have a good history of paying things back? And that will give me a score on how reliable I am. And if you Google credit scores, you're going to see a range, and it goes up past 800, but a lot of people, that's kind of the top, is 850. Okay, so how do we establish this credit? So there's a lot of ways that young people can establish credit without getting into debt. And these are great ideas even for adults. So if you're thinking, I need to even increase my credit, these are really great suggestions also. Okay, I am not a fan of just taking out a credit card. Okay, I am not going to tell you to go take out a credit card, go into debt in order to increase your credit score. That is not what I'm here for. There are great ways to utilize a credit card, but if you are one of those that does not have good credit or has a history of making poor decisions around credit cards, opening up a credit card is not a good idea. So these are some good suggestions to do early on that won't cause you to go into debt, which is what I'm trying to keep folks out of, is debt. The utilization of a credit card is great if you could do it in a healthy way. So I'm not saying don't, I'm just saying we got to learn to do this with healthy behavior behind it. Otherwise we go into debt, and that's not what we want. So a secured credit card is one of those options that is really great, and anyone can do this over the age of 18. What a secured credit card is it's a lot like a security deposit on a credit card. So if you look at the example here, you can go to say UBT and say, I want a $500 credit card. which would give you a spending limit of $500. But what you do is you come to the table with $500 cash and you say, I want a $500 credit card. Here's my $500 cash. And UBT will take your cash and then issue you a credit card that you can spend up to $500 on. It still works like any other credit card. It is attached to your credit report. So all of your payments still need to be made on time every time. You need to pay it off for healthy behavior behind a credit card. But when you spend money, you're going to get a bill at the end of the month. So let's say I go to the gas station and I spend $57 and that's all I do for that month. I'm going to get a bill at the end of March saying I spent $57 on my credit card and I need to pay it off. So then I'm going to send them $57 to pay it off. Next month, I'm going to do the same thing. Maybe I spent $300 because I needed new brakes on my car. So I spent $300. I'm going to get a bill and it'll say a minimum payment. So I could pay my minimum payment of say $30. I'm still going to owe some money. And every month I'm trying to pay off this credit card. And let's say I do by December and I've actually raised my credit because I've paid on time, paid off my credit card. I've used it, then paid it off. I've done healthy behaviors with my credit card. And you know what? I'm done now. I don't really want this card anymore. I'd rather go get a different card, maybe with some points, something like that. So I'm going to go back to UBT and go, I'm ready to close it. They're going to go, okay, great. Well, you don't have a balance. You don't owe anything. So we'll close your card and here's your $500 back. Okay. So it's like a security deposit. Now, if I were to go and close it and they look and they say, you know, you owe $100 on your credit card still. Here's $400 back to pay it off. Okay. And then I paid off my credit card, they closed it, and they gave me the rest of the money back. So it's like a security deposit when you go get an apartment. You're going to pay probably another month's rent for your security deposit. And if anything is broken outside of wear and tear, if anything's ruined, they take that money out of your security deposit and they give you back what's left over sometimes. So it's that same thought process. This is a really great way, number one, if you don't have credit, to get a credit card because the bank doesn't have any risk involved. So they're willing to take a chance on Caitlin Moore because if say I max out that credit card of $500 and I don't pay the bill, they can close the account and keep my $500. There's no risk. They didn't lose anything in this matter. It's a great way to increase your credit because for the same reasons, the bank doesn't have any risk. So even if I have bad credit, let's say my credit score is 430, that's considered bad credit. There's no risk involved for the bank to give me this because they have the cash already. So if I rack up $500 worth of credit card debt and I don't pay it off, they're going to close it and keep the $500. So it's a really great way to increase or establish your credit card, but you have to come to the table with the cash. $500 is usually the minimum. Not all banks do this. Bigger banks do. I can't speak for big national banks, but I will tell you that UBT does a secured credit card and $500 is the lowest amount. So if you wanted a $2,000 credit limit, you could also do that. But if you're trying to start your credit for the first time or build your credit, I would suggest doing a smaller amount. This doesn't give you wiggle room to buy whatever you want. Maybe you just put your bills on the credit card and then you pay it off with your cash. So if you have a healthy budget and you're spending things that you've already budgeted for, maybe gas or your groceries, and you're putting that on your secured credit card, you're already budgeting for your paycheck to pay for that. So then just pay it off when your credit card bill comes. That's healthy credit. That's called revolving credit. When I spend a little, pay it off, spend a little, pay it off. But I'm not going to go spend it on a new TV. I'm going to spend it on something that I've already budgeted for. So that if I have a $300 grocery budget, so every month I'm going to plan on spending $300, maybe I just swipe my secured credit card, rack up that bill, and then when I get it, I put my $300 on it. That's really good credit habits that will increase your credit very quickly. But you have to come to the table with the $500 or whatever you'd like to do above that. Any questions about the secured credit card? Okay, I'm going to keep going here. Okay, cosigners. This is another way to establish credit. If somebody is willing to help cosign, which means maybe you go to the bank and your credit is low or you don't have any credit and you want to get a loan for a car, for example. If you have somebody that does have good credit that is willing to sign their name also for that loan, They are basically a co-owner of that loan. So let's say I go to the bank and I want to take out a $10,000 loan for a car, but my credit's not that great. But my dad has good credit, so he's going to co-sign that loan. Now, the risk involved is that if I don't make the payment on that loan, my dad is legally responsible for that. But he has the good credit that's going to get me that loan. So if I have good budgeting behavior and I'm paying my payment every month, then my credit score is going to go up. Your credit score is affected by payments that are made on time every time, and you're making the right amount or more for your payment. So if I make good payments every month on time every time, my credit will go up, and so will my dad's. If I make poor decisions around that and don't make my payments or don't pay enough, my credit will go down, but so will my dad's, because he is the co-owner of this loan. Okay. So it's a good way to get loans or credit cards if you have a co-signer, but there's a lot of risk involved for the co-signer. There's a lot of risk for you if somebody asks you to be a co-signer. I'm never a fan of somebody being a co-signer. That's a personal conviction I have. It's very scary. Now, it's not to say that honestly, my dad hasn't co-signed for things in my past, but it's very risky. So if somebody does ask you to co-sign, you need to do your homework to make sure that they can afford to make those payments, because if they do not, the bank is going to come after you for those payments too, and it can affect your credit score. So it is okay to ask questions of somebody asking you to co-sign. How much do you make every month? What is your budget? May I see it? There's nothing wrong with that, because they are putting you in debt and they are putting your credit at risk and your ability to get more credit or take out a loan. So if I don't pay my bill and my dad is responsible for these payments now, or I make our credit scores go down, he will not be able to get a loan. He will not be able to open up a credit card because his credit score is gone down. So the reverse is the same. If you're going to co-sign for someone, be very cautious about this, because they could essentially not make their payments and you are now responsible. Okay. I had a question. What is the interest rate with secured credit cards? I believe it's the same as regular credit cards. So if you go to a bank and ask for a secured credit card, there will be an interest rate involved, but you're not charged interest if you pay off the card every month. So if I spent $100 this month and I got my bill for $100, if I paid that in full, I will not be charged interest. The only time you're charged interest is if you do not pay it off. So you have 1 month to pay it off. And then in April, if I still hold any sort of that balance, let's say I only paid $50 this month of my $100, the rest of that will be charged interest. Okay. So that's another thing. Though your interest may be really high, as long as you are paying it off, you will not be charged interest. Okay. Still be cautious about it. I'm not saying ignore the interest rate, but just know that interest is only charged if you do not pay it off, which is a good, healthy credit behavior. I've heard it said in our wealth management department. So these are the folks that are helping people with millions and millions and millions of dollars. They all use credit cards. Okay. But the phrase that they use is rich people don't pay other people interest. Okay. So they'll use the credit cards because they're getting points, miles, whatever it is. But they pay it off every month. So I really thought, when I was told that, I thought, man, I may not be a millionaire by any means, but I could sure treat my credit like I am. So if I pay my bill off every month, that's me being responsible for my own dollars, and I don't owe anybody interest rate at this point. So that is a rich person, as they say, a rich person behavior is rich people don't pay other people interest rates. So if you can get in the habit of only spending what you can pay off, that is a very healthy habit. Find a credit card that works for you with the points. If you travel a lot, use an airline one. If you like cashback, use an Apple Card. There's various cards out there that have points and perks that work for you, especially if you're paying them off every month. You don't have to worry about the interest rate and going into debt. That is paying someone for a loan that you do not have to pay for. So only spend what you can pay off. I also have another thing outside of cosigners. I like to tell people only get a balance, like a credit card balance, that if you don't have enough money in the bank to pay it off completely, you should lower that. So if a credit card company comes to you and goes, you're approved for $1,500, you can actually call them and say, I want this knocked down to $700. You can ask them to lower it. They'll fight you, but they have the power to do it. Because if I don't have any more than $700 in the bank, then that means I will be in debt. Okay. Even though I'm going to use the healthy habit of only spending on my credit card what I have budgeted. But if something were to happen, maybe I have $700 in savings that I can pay it off real quick so I can avoid interest rates. Okay. So if you don't like the amount that the credit card company has given you, if it's too much and I'm just going to blow this on a big TV and a lot of clothes, you can call them to lower the amount. And please do feel free to do that. I talk to a lot of people, every single day that do not have healthy credit habits, and they don't like the amount that they have because they feel less in control when they have too much money to spend, a bigger loan. So you can lower it. So co-signers, same thing. If you are co-signed on a credit card, if you're a part of that, you are responsible for the payments. All right. Other ways to establish your credit without using credit cards. Okay. High interest loans. Think like small car dealerships, the privately owned ones. A lot of times you can get a car loan from them and get a car, but they have higher interest rate involved in those loans. But they are willing to give those loans to folks that don't have great credit. The trade-off is you're paying higher interest. So it's not always a good idea. Just because you can doesn't mean you should. So small dealerships with high interest loans, if there's a high interest loan out there, it usually means that they will give it to somebody with lower credit. But if you can handle that and make the payment on time, every time, get it paid off early, your credit score will go up. But I don't suggest this being your first route. Your phone bill, if you ask, can be connected to your credit score. So if you're making on-time payments every time, then that will help. You have to call them and ask. Household bills, your utilities can be reported to the credit bureau, but you have to ask. It's very hard to get them to do it. But if that's your only route right now to your credit score, then by all means, call them, call Black Hills, call whoever you're using for utilities and ask them if you could get this reported to the credit bureau on your behalf. Because if you're making those payments, you're paying it off every month, it's going to help your credit. Be an authorized user on someone else's credit card. So I always think in terms to explain this of a parent having a credit card and letting their youth be an authorized user. So this is when I talk to a lot of high schoolers, this is an option that I tell people. The credit card is in their parents' name, but they can allow a minor to use the card, and they have a credit card with the minor's name on it. This is automatically connected to the minor's credit score and their credit account. It doesn't mean the minor has to use it, but every habit that the parents have will affect whoever is an authorized user on the card. So you have to be careful with this, but it is an option for some people. Store credit cards is another way. So we'll think Old Navy, Gap, Shields. They have in-store credit cards. I think Shields is more of a Visa, though. You can use it anyway. But you know what I mean? The credit cards that go directly with the store. So if you shop there a lot, that's a great way. They will often approve credit for folks with lower credit because they have high interest cards. And you can only use it in their store. So the downfall to this is you usually get a lot of credit involved in that, but you can only use it at the store. So if you think of Old Navy, not to throw them under the bus, but if you could get $1,000 credit card with them, the only place you can spend it is in store, and that's only clothing. So you can't really get essentials with that. And so people tend to let that rack up. So they have a large bill and high interest rate involved. If you are going to go the store credit card route, I would suggest finding a store that you use often, like a big box store that offers these, say Walmart as an example. You can get an in-store credit card there. You're approved for a certain amount, but you can get essentials there. So if you're going to buy groceries, go to Walmart, put it on your Walmart card, and then pay it off. You can get clothes there, and shoes and socks and shampoo and everything that you're budgeting for as an essential, you can get it at Walmart. And so you can swipe your card and then pay it off. They are going to have high interest, so you have to be very cautious with this. The worst thing I have seen with store credit cards is I work with a lot of folks that have 10, 15 credit cards, and they're all store credit cards. So we're talking Gap and Old Navy and Scheels and Macy's and Dillard's and all these stores, but they're all making minimum payments. They're making 15 minimum payments. Let's say the average is $30 a payment for 15 stores. That's $450 of minimum payments on high interest credit cards. It's not a good idea, and it can get way out of hand. So if you're going to go this route, please maybe choose one at a store that you're budgeting for. Maybe call them if you have too much credit there. So if they give you 1,000, maybe you only want 300. You can ask them to lower it so your spending does not get out of hand, and then put that in your budget. So if you spend a certain amount on clothing every month, maybe you only buy your clothing there and then pay it off. So if you're budgeting $100 a month towards clothing, go to Old Navy, spend your $100 on your store credit card, get the bill, pay it off. You don't even have to wait for the bill. Just get online and pay it off. But be very cautious with this option. Secured loans is the same thing as a secured credit card. You bring money to the table. A lot of times small businesses do secured loans, because why would you need a loan if you have the cash? Businesses do this to kind of tie some cash up where they don't spend it. So it just works for them. We see that a lot with small businesses. And then getting your bills on your credit report. This is where, like I said, utilities, things that you may not see on your credit report, you can actually get them to report it there. But it takes a little bit of work, but if you're determined to do so, I would suggest doing it. That way you don't have to go into debt. It's already a bill that you are paying, okay? If you own a home though, your mortgage is reported to your credit bureau. So that is a way to increase your credit there. The main thing with increasing your credit is paying your bill on time, every time. On time, every time. I say that a lot. You'll hear me say that for everything. If you work with me one-on-one, I will say that all the time, on time, every time, because that is very important, even if you're just paying minimum payments. If you skip a payment, miss a payment, it goes on your credit report. And if you're going to get qualified for loans down the line, like say a home loan or an auto loan, the bank is going to look at your report and see how you have paid things off. So if I missed something 3 months ago, they're going to say, you're a risk now. You're a high risk if you missed something or it was late. A lot of times, like I have a mortgage and there's a grace period. So I do on the 1st, but I have 10 days to actually get it in. Anything over that is reported as late. So a lot of places will have some buffer room, and they'll call you during that time because it takes a lot of work for a bank to report this anyway. So they would rather you just pay on time every time. So make sure that you're doing that, because even if you're paying minimum payments, it will help increase your credit to just have things on time and increase your chances of getting higher credit and more loans in the future. We've already talked about that. Just as some examples before we close today. So ways to increase your credit score if you already have credit established. So one of those is pay off all debt in collections. So pull your credit report and pay off the collections. And if you need help with that, I know some tricks of the trade to get collections paid off a little bit faster. But collections will drag your credit score down significantly. But once it's paid off, it takes about two months, and you will see your credit score shoot up. So one of the great things about collections is once it's gone off your report, your credit score does rebound fast. But the longer a collections debt is there, the lower your score is going to be. So if you open up your credit report, because we're all going to pull it this week, if you open it up and you have a lot lower of a credit score than you thought, it's likely due to collections. So check that out. And even call me if you have questions. I would absolutely love to help you with that. Make your payments on time every time. Maxed out credit cards should be paid down to about 30 to 50%. So if you already have a credit card and it's maxed out, and there's an example here, if we could get it paid off at least 50% of that, that will help your credit score. So if you have a credit limit of $1,000 and you owe $1,000, if you've spent that, if you can get it paid down to about $300 to $500, that will be in your favor. If you could pay it off, that would be even better. But if you could at least get it down that much, that will help your credit score. So that's a quick way to rebound your credit. And then after that, just put a little on it, pay a little off, put a little on it, pay a little off. Credit bureaus actually will give you a higher score if you have a little debt. They don't want to see your full $1,000 in debt, but they want to see a little bit. It's crazy that your credit score is a reflection of your credibility. How reliable are you to pay off your debt? But they want you to be in a little bit of debt. I say just pay it off, get it paid off, stop spending on it, and then pay it off. But if you can't afford to do all of that at once, at least get it paid down a little bit so that there's room on your credit card, and stop spending on it. Okay. It is okay to have $1,000 of open credit. You don't have to use it. I have 2 credit cards. I have 3 credit cards total, 2 of which I haven't touched for years. It's just open credit that I have. And then the other one, I do revolving credit. I spend a little, pay it off, spend a little, pay it off, because I get points and things like that. But having open credit that you don't use is okay. Okay. Some people will tell you differently. It is okay to have open credit. I do talk about increasing your credit card. I am not a fan of this. This is just one way research says that you can increase your credit. So if you have your $1,000 credit limit maxed out, you've spent $1,000. If you call and ask to increase it, maybe they'll increase it by another 1,000. So now you have $1,000 of open credit. You've spent 1,000. Now you have 1,000 more that you can spend. If that's 50% now. So that's going to increase your credit score because you have open credit at this point, and then you could keep paying it off and have more and more open. So I don't suggest doing this if you don't trust yourself to not spend that money. That's a big thing. Don't increase your credit limit. Not everyone will increase it, but don't increase it if you're in a lot of debt or if your credit card spending is out of control. It's not a healthy behavior, and it's going to just open up the door for more debt for you. Maybe one day, but not right now. Be patient and stick with it. When it comes to increasing your credit, it does take time. Do what you can when you can to increase it. Closing credit cards may actually lower your credit, but it's okay. It will rebound in about 3 to 6 months. So if you're one of those, like I've worked with someone that had 16 credit cards, store credit cards, so they couldn't spend it anywhere but the store. And as she paid them off, she closed them. Now, paying them off helped her credit, but then closing it lowered the credit. So she was doing this back and forth thing. But after 3 to 6 months, it'll skyrocket. Okay. It is not a bad thing to lower your credit score right now in the name of getting out of debt. Please don't worry about your credit score if you're making healthy changes. Give it a 3 to 6 months, and you're going to see a significant difference. If you could pay off cards, close them, things like that. So don't be afraid of your credit score right now. It will help it in the long run, because if you can stay out of debt, that is most important, and it will help your credit score in the long run. Most important steps: make your current payments on time every time. Don't sign up for any more credit cards. If you're in credit card debt, don't sign up for any more. It's not going to help your credit score. It will lower it. It's called debt to income. If you only make this much and you're in this much credit debt, that's not going to be in your favor. So taking out more debt is not going to help you. You will never get a loan. You will never get a mortgage if your debt to income is too high, meaning you owe more than you make in a certain amount of time. So don't open up more credit cards, and then pay off debt as soon as you can. I work with folks to set up debt payoff plans. If you need help with that, I can literally sit down with you and tell you the month that you'll have everything paid off based on your income. So if you need help with that, I only take on a couple clients at a time, but I could definitely put you on the waiting list, and people are constantly revolving. So like a revolving door, because it doesn't take that long to do this. And it's free. You don't have to bank with us either. So if you do have questions about debt, collections, your budget, I'm happy to help you with that. This is my contact information. That's my office line. Leave me a message and I'll get back to you. And then my email is my name, caitlin.moore@ubt.com. So we're going to stop here for the evening. It is 7 o'clock. So I will get this all on YouTube so that you can reference back. There's a lot of information. So feel free to ask questions. We'll be back in 2 weeks to do the same, not the same lessons, but we're going to keep going on all of these different lessons. And there's several in one night. So if if you don't, you may have already known about debit versus credit, but when we're talking about credit, you don't know. So always come back because there's a lot that you may not know, and dig deeper into these topics. So thank you everyone for coming tonight, and we'll see you in 2 weeks.